Okay. Hello, we are Natalia, Laura, and Melany, and we are going to talk about emerging capital markets and globalization. So, um, by chapter one, why wider capital market development, we have that in the case of Latin America, policymakers are left without clear guidance on how revise the reform agenda, and many of them do not envision a bright future for domestic capital markets, particularly for the local stock markets or the smaller emerging economies. So why is this important? Growing empirical evidence suggests that financial development is not just correlated with healthy economy. It actually causes economic growth and has a positive impact on poverty alleviation and income distribution as well. Um, so why does financial development matter? Empirical evidence shows that more developed countries have deeper and more efficient financial systems, including capital markets. But from a theoretical perspective, financial development can both grow through several channels. Mm, the first channel is financial intermediaries arise to undertake the task of researching investment opportunities and to sell this information to investors. They might also boost the rate of technological innovation by helping identify entrepreneurs that are more likely to successfully carry out profitable projects and launch new products. The second channel is risk amelioration through diversification. By this mechanism, financial markets may also help investors deal with liquidity risk because they allow investors to hold liquid assets such as equities, bonds, and demand deposits and transform those liquid instruments into long-term and more illiquid capital investments. The third channel is improving corporate governance. Financial intermediaries may help reducing monitoring costs. They may also affect economic growth by reducing the transaction costs associated with collecting savings from disparate investors. So, to answer the question about whether the financial structure matters, understanding financial structure as a mix of financial markets and banks operating in the economy. We have that proponents of market-based financial systems argue that banks may acquire too large an influence over firms and might be able to extract rents from them, increasing the cost of accessing capital. Also, markets and banks may provide complementary growth, enhancing financial services. For instance, by offering alternative means of financial investment, security markets may reduce the potentially harmful effects of excessive bank power. From a broader perspective, having both well-functioning banks and security markets can increase the stability of the economy as shocks to one particular sector of the financial system can be at least partially compensated by others. So, in the evolution and globalization of capital markets, we have that the development of capital markets in rich countries have been accompanied by an increasing financial integration across nations. This globalization is not new. International capital flows have existed for a long time. 100 years ago, capital flows tended to follow migration and were generally directed towards supporting trade flows and infrastructure investments in then developing world. For the most part, capital flows took the form of bond flows and were long-term. In the advent of World War I, representing the first blow to this wave of financial globalization, after these events, government reversed financial globalization, imposing capital controls to regain monetary policy autonomy. The international system was then dominated by the Bretton Woods arrangement of fixed but adjustable exchange rates, limiting capital mobility and autonomous monetary policies. In the 70s, we witnessed a new era. As a result of the oil shock, rising capital mobility operating through the euro-dollar market, and the subsequent breakup of the Bretton Woods system, countries were able to open up to greater capital mobility while keeping the autonomy of their monetary policies. In the more recent globalization phase, the action has taken place among developed economies. In this phase, capital flows across developing countries have increased sharply. At the same time, capital market activity has concentrated in a few large international financial centers, mainly Frankfurt, London, New York, and Tokyo. So with these, different forces have fostered the recent wave of capital market development and financial globalization. These factors can be grouped into three categories. First, government policies. In this, we have that governments have fostered capital market development by liberalizing the financial sector. The liberalization process entailed many measures like elimination of interest rate controls, the scaling down of direct credit programs, the liberalization of stock markets, and the opening of the capital account of the balance of payments. On the other side, we have the technological advances that have eased the use of capital markets by reducing transaction costs and making trading, clearing, and settlement activities more efficient. A significant financial innovation has been the securitization of illiquid assets, most notably of mortgage and consumer loans, to transform them into liquid securities that trade in capital markets. And finally, we have change in the demand side have also provided an important boost to capital markets. The emergence of institutional investors, such as mutual and pension funds, has enabled retail investors to purchase securities at low cost and at the same time diversify their investments in a array of assets and even across countries. With the developing countries and the globalization process, we have that the global trends affected developing countries in at least two ways. On one side, we have that new capital became available on international financial markets, with developing countries trying to attract it to their domestic markets. And in the other side, we have developing countries trying to emulate the increasing use of capital markets that characterize developed economies by reforming their local markets. So, starting with the boom in capital flows of the 1970s and early 80s, that was followed by the debt crisis that started in Mexico in 1982. To solve this crisis, the so-called brandy bonds were created, starting in the late 80s, leading to the re-entry of emerging countries into international capital markets and the development of liquid sovereign bonds market for these countries. The more recent wave of capital flows to the periphery differs markedly in at least two ways from the 1976 to 82 period of capital inflows. First, in terms of magnitude, and second, in terms of flow composition. A salient feature of the recent wave of financial globalization has been the internationalization of financial services, that is, the use of international financial intermediaries by local issuers and investors. The internationalization has been achieved through two main channels. The first channel is an increased presence of international financial intermediaries in local markets, and the second channel involves the use of international financial intermediaries in markets located outside the country by local issuers and investors. And finally, in the side of policy implications, we can the evidence indicates that capital markets in Latin America are below what can be expected. After controlling for relevant factors, including per capita income levels, economic size, macroeconomic policies, and the degree of legal and institutional development, the evidence also shows that the relation between globalization and domestic market development is complex, and in many cases differs from what was expected at the beginning of the reform process. So, the author identifies three typological views. The first one is called Be Patient and Redouble the Effort. In this contents that past reforms were essentially right, that the reform needed in the future are mostly known, and that reforms, especially second generation ones, have long gestation periods before producing visible dividends. It thus recommends letting market discipline work while forging ahead patiently with further reform implementation efforts. The second one is called Get the Seconds Right. And this one draws attention to problems that arise when some reforms are implemented ahead of others. In this one, key preconditions should be met, including the achievement of a minimum institutional strength before fully liberalizing domestic financial markets and allowing free international capital mobility. But these two views do not properly address some relevant aspects of the evidence. So we have the tiered view. This is called revisit basic issues and reshape expectations. It contends that perhaps the most questionable aspect of the first two views is their implicit assumption that domestic capital markets development in emerging economies should be measured against the benchmark of capital markets in industrialized countries. Indeed, for the first two views, the reform path may be long and difficult, but the expected outcome is, in most cases, only one: to look increasingly like a mini Wall Street. The third view thus invites a serious analysis of the implication of these characteristics, in particular for the reform agenda going forward. With the second chapter, we have.
Okay, so let's remember that the capital markets refer to the venues where funds are exchanged between suppliers of capital and those who demand capital for use. We must bear in mind that the best known capital markets include the stock market and the bond markets. Now, I would like to make a few remarks concerning the developments in the capital markets. To start, it's really necessary and important to know the global context, since the financial system has had already changes in recent decades. To illustrate this point, let us consider its role after the early 70s and boom during the 90s. As we can see in the graph in some select countries, all in all, the main factor behind the strong rise in equity markets are first, financial liberalization and deregulation; second, the creation of revolutionary technological and financial innovations; and third, a growing base of dedicated investors. Next, please. Okay, now, one of the main questions to come up is how global trends have affected developing countries. Generally speaking, financial globalization affects capital flows to emerging markets. Let me give two examples. First, through changes in the volume and composition of capital flows, and second, through the internalization of financial services. The increased availability of liquidity in international capital markets have several booms in capital flows to developing countries. So consider the oil price boom, the debt crisis that began in Mexico, the Brady initiative, and the East Asian region crisis. So next. Okay, so the first graph shows us the wave of capital flows to emerging markets, where the 90s differ from previous years due to the magnitude and composition of the flows. And in the second graph, you can see that some countries receive large amounts of private inflows, while others receive little foreign capital. Thus, next, the global trends described above affected developing country in at least three ways. So, as you can see in the screen, so first, capital was made available in international financial markets, and developing countries tried to attract it to their domestic markets. Therefore, international financial institutions will move to developing countries by local banks and establish local branches or subsidiaries. So, second, developing countries attempt to emulate the increasing use of capital markets that characterize developed economies by a series of reforms. And third, policy markets were increasingly aware of the need to properly manage the risk of capital inflows. So next, please. Okay, thanks. So with the above, Some reforms were implemented in emerging economies to promote the development of local capital markets. In the graph, we can see the interactions between the most common reforms of the financial sector, supply and demand, and the expected results. Therefore, policy markets implemented different reforms, but the analysis show us that these have not really been implemented. So, next. Okay, so it can be analyzed that the position of Latin America was not aligned to global development, and that globalization and financial innovation play an important role in the process. Next, please. Okay, so let me conclude this part by saying that Latin America capital markets continue to be dominated by banks and characterized by short-term and equity, and in several countries by a high degree of dollarization. In addition, the bond markets have achieved a significant increase in volume, but most of it corresponds to the role of the government. So, next. Okay, finally, the poor state of development of capital markets in Latin America and their high degree of internalization raise several questions that we will answer below. So you can see this question on the screen, and next we will answer below.
In this chart, the factor behind development and international of capital markets. Next, please. And we will talk about the 5 subtopics that will focus on that topic. Next, please. To start with the determinants of the capital market difference between the bond and share, that must be considered the base and risk of profitability, expiration, rise, and acquire. The aforementioned are realized in bonds that ensure the bond market investor to negotiate, buy and sell in data security, which can be issued by companies or government with the specific period and interest they is charged. Ensure the represent of the bar share capital of a public limit company by the acquiring share where obtain the category partners with their rights and obligations. Next, please. Now, the 4 variables that affect the capital market: income. The higher income countries have better quality institutions, including more the capital market. In addition, the less development countries have more volatile investment environments and greater government intervention in the economy. Monetary and fiscal policies, the control inflation, low interest rate, and aggravate the credit market frictions and lower investment and distort the price. For the fiscal policies, a high fiscal deficit can increase the volatility by reducing the incentives to get involved the financial contracts and provoke affect the curling down, a lower investment capacity, of course, that is expulsion of the private sector from the economy by the sector public. A legal institutional environment regulation of protects creditor and mandatory interventions are associated with the more development in financial markets with the less concentration of privileged information. As this is the economy, the stock markets can return efficiency by the expanding the volume and number of actors through the affects the economy scale. Large economy have big companies which achieve equity, liquidity, and development legal framework issue trade financial instruments. The current composition of the ones for the emerging markets foreign currencies due to currently less expensive domestic currencies and give tourists dollarization of e-abilities. And next, please. Impact of reforms. The first is the liberalization of the stock market is a decision for the investor buy the shares in the local capital market, and domestic investor buy the share outside increase the range of the capital for local companies and broadening investor base, leading the greater liquidity. And in the legal framework, the focus enforceability or the regulation of the use privilege information electronic trading improve market performance by an increased liquidity and efficiency and more capital markets. The privatization programs promote economic efficiency by reducing government interference in the economy. The directly impact of the capitalization domestic domestic market by the share offering of the local stock exchanges. Institutional reform, the ground rates consists in the reform. The next, please. Next, please. The internationalization of the capital market, the globalization increase the capital market activities to take place outside. Many companies are now across register of the international stock exchanges behind a particular opportunity. Popular instruments accessing international market, but better domestic environments increase access for the investor and role international market when the economy base of the country improve. There is a great amount of external financing and ready liquidity and lower cost capital. They have more participation of the international market. Please, next. Impact of the internationalization of local equity markets. Impact of the internationalization of trading activities affect liquidity of the local equity markets. Migration is also present. Internationalization induce a shift of negotiation of international companies from domestic market to the internationalization financial center, since they are less transaction costs and more information. Spillover means that greater trade the volume in market from individuals stock that increase costs, trading domestic stock transactions and reducing liquidity. Internationalization improves in reputation in the standards, transparency, coverage, and reduce information costs. And next, please. And finally, the domestic development of the capital market in America. Latin America capital market remain under development when they compare of the markets in industrialized countries and East Asia. And finally, the Latin America countries have small and less active equity markets that countries with the similar financial base and policies of the other regions. That's it. Thank you.